Happy Wednesday. Welcome back to another week of the Educated Home Buyer Live. Josh and myself here to answer your mortgage and real estate questions while updating you on everything in the economy. Josh, we got some weaker economy type news. We got some craziness happening with tariffs. And with that, we've actually seen the 10-year pull back. Rates are improving a little bit. All of this we're going to dive into tonight. But what do you want to start with, Josh?
I just point out that, they say like the last day before a vacation is your most productive day because you're just hurrying and rushing and you get so much done. Like the last hour before we start this show might be my most productive hour of the week. I'm just, it's like paper flying,
Scurrying.
the keyboard,
Scurrying
just like keyboard cat, just tapping away on the cat, getting stuff done.
People have no idea the chaos that it takes to get us on this thing, everything that's happening. With that, the title of the show, Mortgage Delinquencies Are Rising. The question of should you be worried? We're actually going to dive into a chart here, one that's circulating the internet right now, getting a lot of clicks, a lot of views, a lot of misinformation and misunderstanding around it, which is really, really important. So we're going to talk about that. Housekeeping item before we dive into charts tonight, though. You might have saw as we were coming on, we're doing another first-time home buyer seminar, a free webinar. Webinar. We're going to use that synonymously, if you will.
Only because Jeb can't remember that.
Only because I can't remember which one I put it as. But April 22nd, shortly after tax day, we're going to go over it. It's going to be 5 p.m. It's a Tuesday. It's going to walk you through everything you need to know to become a homeowner. Again, it's free. Share it with people you know. You can register jebsmith.net/webinar or /seminar, whichever you'd like. That's how bad it is that we did both because I just use them. I interchange both of them. So it's scrolling at the bottom of the screen if you want to know the address. So just go there, register. You'll get updates. It's 3 weeks away, so you got some time, but wanted to throw it out there. All right, Josh. Shall we start with some charts as we always do and update our fellow educated home buyers
for our visual learners amongst us?
Yeah. So inventory, what's happening with inventory? It is still rising, which is expected. Total supply of unsold homes sitting on the market, 676,000 single family homes up at the on the moment. At the moment, up nearly 31% over last year. So 31% more inventory on the market than last year, 30.6 to be exact. What does that actually mean week over week? We went from 668,000 homes to 675,000. So in context, about 7,000 homes there. Last year, our peak was at 739. We haven't hit that yet, but we are on our way and headed in that direction. And it's actually going to look at Orange County here as we always do. Orange County up 3.36% week over week. 3,689 homes. We have now passed the highest level, Josh, that we saw in 2024 for Orange County inventory. But Huntington Beach actually pulled back a little bit here week over week, sitting at 3.11% week over week. Again, even though inventory is picking up year over year, as you can see from these charts, we're still well below those pre-pandemic levels here locally. That's why a lot of homes are still getting multiple offers, going off the market quickly. But again, it's all about price, where the home's located. It's all about how it's priced. Those things are determining a lot when it comes to how quickly things are moving.
Jeb, apparently it's such a hot market that agents don't even need to call other agents back and let them know they accepted another offer.
That happened to me. I was not happy. But yeah, not all agents do business the same way, guys. And sometimes I feel the need to tell people that. You shouldn't do that, but I do occasionally. Weekly sellers count. So more listings coming on the market, 68,000 new listings, 13% more than last year, 24% more than 2023. This is a positive thing because as long as new listings are growing like this, you're going to see inventory continue to grow, which ultimately is what you want to see as a buyer. Home prices, median price of this week's home sales sitting at $395,000. It's up 0.6% over a year ago. So pretty much flat year over year. Very, very little to talk about there. Pendings, home sales are sneaking up a little bit above last year at this time, 69,000 single family homes. And a lot of it's mortgage rates, right? Mortgage rates are allowing more transactions to happen. It's not a significant amount, but it is helping out. And I think as rates can trend lower, we're going to see more of that. But I think the big news here, Josh, price cuts. 35% of the homes on the market have taken a price cut, which is quite a bit more than last year, and it looks to be accelerating. So we will see what that looks like. I mean, as you can see from these charts here, that tends to grow all the way up until, you know, August, September. So the trend is up. But we will see what that looks like here in a couple of months if rates do come down.
Probably has something to do with that inventory growing through those next 3-4
Sure.
months, because there's more competition. If you're insane and come on the market in December and there's not that much competition, less pressure to cut. But when you're in the thick of selling season with other opportunities, I don't know what you're seeing, Jeb, but like that home that you guys didn't even get a reply back, it was, I thought, hey, they have a pretty good chance on that. It's not one of these Pinterest, HGTV, perfect turnkey homes, but that price point is an entry-level price point in LA County, and
it's weird. When I called initially, no offers on the property. We submitted an offer. Didn't get a call back. Thought we were still the only offer. Didn't get a call. I called them to figure out what was going on about a day later and found out, yeah, the seller accepted another offer. You're in backup. I'm like, okay, I didn't even know you had another offer. But you know, we submitted a full price offer, shortened contingencies, did all the things that we should have done, still didn't get a call back. But nevertheless, that it is the market. It is what it is. But just shows you, you know, different price points, still a lot of activity out there. Huntington Beach, you know, I put that property on the market for 1.65 a week ago. It sold in 2 days. You know, and that's a higher price point. The property we're just talking about is at a 700 something thousand price point. A lot less, but same activity in both directions. So this is the chart, Josh, that seems to be getting all the news out there on the internet, because the internet goes with a tagline that FHA delinquencies are sitting at an all-time high, and they quote something like 11% of FHA loans are in default, but they're using this chart. The problem with this chart, Josh, is that two things. One, this is Freddie Mac's serious delinquencies, not FHA, has nothing to do with FHA. Secondly, it's delinquencies on 5 or more units. So this is commercial. This is not residential, guys. So when you see the headline out there and you see people quoting this information and using this chart, understand they have no idea what they're talking about or what they're looking at. And yes, delinquencies are higher in commercial and multifamily, but that's not going to impact.
And let's talk about why, Jeb. 5+ units. It is almost impossible to get a 30-year fixed. So you get a 5-year ARM, a 7-year ARM, a 3-year ARM. So a lot of people, it sounds as crazy as it sounds, a 3-year ARM. Well, if you can get a 3-year ARM at 2.25 on your 10-unit building, a lot of people did that just believing that, well, I'll just refi every 3 years. Commercial refinances are more expensive, but hey, I want my cash flow. The property's going to go up. I might flip the property. So we don't have a vacancy problem. It's not that these people aren't collecting rents. It's that they had loans that rolled over, and the cost to finance the interest expense is through the roof. So that's why delinquencies are going through the roof. Now, when we talk about residential properties, why are we not seeing that in residential? We have some charts here that are going to show you exactly why not, because people are sitting on records amounts of equity. 40% of people own their homes free and clear. The ones that do have
Don't do the spoilers, Josh. You're spoiling everything.
Little loans that they do not have a high interest rate on. So we're going to go through all that fun stuff.
Good stuff. I don't even remember what I put in here. Total balance by delinquency status. This is good to note. It just shows you, you know, people that are 30, 60, 90 days, 120 days, severe delinquency, if you will. And then you look, we're not even back to 2019 yet, right? And I don't know if you guys remember, but nobody in 2019 was talking about delinquencies and the market crashing and all of that, right? We're not even back to normal times. So just when you see these headlines and you see the information, just always understand the context, understand, you know, who it's coming from, for one, because there's still a large group out there that are still pushing this narrative. They want to be right. And the reality is they're not. And
they say, Jeb, a stop clock is correct twice a day. Sadly, the clock has gone around about 48 hours so far, and they still haven't been right. The reason why is they know they're not right.
48 hours or 5 years.
They literally not. I'm saying if you go 48 hours on a clock, even a broken clock is right 4 times. They haven't been close to right 1 time. And there are some of these people that are just dumb. many of them I don't think are dumb. They're manipulative. They're marketers, they're salespeople, and they know that one of the easiest things you can sell is doom and
Fear.
gloom to people that want it, fear, doom and gloom, or hope to people that are hoping, praying that 2008 is going to happen again, and the $1 million house in their neighborhood is going to be $400,000, and they'll be the one sitting on cash and can buy it. So a lot of manipulation there. The data tells you everything you need to know. And housing, Jeb, we've talked about this before, is not a stock. If I decide, hey, Palantir went to 125, it's down to 100, it's never getting back to 125, I don't need to own Palantir stock. And it's a couple clicks of the keyboard and $5 trade expense to be rid of it. It's not how a house works.
Agreed. Agreed. This chart I put in here because we often talk about home building and the areas with, growing construction, new home construction. I thought this was an interesting chart because, Houston, basically Dallas or Texas as a whole, rather, is the epicenter of permits that are being pulled. So, if you're in one of these markets, Houston, Dallas, you can go into Phoenix, basically the South Sun Belt that we talk about often is where a majority of this stuff is located. But, those markets, you got to be a little bit more timid than some of the other markets out there because, yeah, you do have these permits being pulled. But at the end of the day, a permit being pulled doesn't necessarily mean a house goes up. It just means they filed for a permit, permit's there. The question is, do they build that home? And that's what you have to watch, right? Not a lot of spec homes being built out there. A lot of, properties under contract and then they get built. So
go back to that chart, Jeb. That actually kind of shocks me. A couple things. Number 8 there, New York, Jersey City, 6,000 permits. That's not a lot. Number 1 is there on the list is 25,000, and then you get to Long Beach, LA, Anaheim. I don't know how they have 6,000. We don't have.
Yeah,
any
but
land.
Look at you're including Los Angeles, Orange County. Like you're including 2 huge counties. How many people are between those 2 counties?
There's a lot, but I just say, look at it. Like one of the bigger developments I remember being put in here is the one that we've got right here off of Gothard right now. And what is it? 30 units?
Yeah, 32.
You need 200 of those to get to 6,000.
But I just think locally, Josh, you got the one that's off of Garfield and in Fountain Valley there on the right. You've got these little infill developments everywhere, right? And say 20 homes here, 30 homes here, 20, and so those start to add up, especially when you start looking at how big LA County is, how big Orange County is. This is a vast area. This isn't, one, we're not talking about Dallas, we're talking about a whole big area. So I don't know. The number's still, 6,000, but still, I guess I'm not shocked by that, just based on how big everything is. But who am I? I don't know. Home buyer housing payments, Josh, we've talked about this, up 5.3% year over year. What do you think when you see this?
So I put this in here to contrast where we're at. So people didn't quite understand in 21 and 2022 why home prices were still going up so rapidly, because with very, very low interest rates. We'll slide forward to it. But you see 2022, when rates started going up, that went really quickly from a median payment of $1,600 to what, by the middle of the year, $2,200. And it's been relatively flat. That dip in 2024 towards the end of the year came way down a couple $100. So we're at the highest level because we're at the highest level of prices and in the range of the highest level of interest rates. So when we look at this is kind of a more important number, because we talk about this aggregate U.S. mortgage debt service payments. So monthly payments as a percent of aggregate U.S. disposable income. So this tells you everything you need to know about 2008 not repeating anytime soon. So why does this stay low when the last chart just showed us where median payments are? Well, median payments are for first-time buyers. We have very few buyers entering the market, not first-time buyers into the market new. If we look over, these last 1, 2, 3, 4 years, we've been at 4 million sales. So 12 million out of what, a couple 100 million households. So it's a very small percentage that are suffering from that. So when we look at this, we actually saw, like I was saying, in 19, 20, 21, as rates dipped, people were spending less of their disposable income to own a home than ever before. And it's kind of normalized now as it's gone back up. And if rates stay high and home prices stay as high as they are, it will trend up. But you see this giant run up from 2004 to 2007. we're not even close to it because of what happened with interest rates going down. We had a housing boom fueled by well-qualified borrowers and really low interest rates and people wanting to own homes. So just very, very different. And then you throw this one on here, Jeb. This one still boggles the mind, that 39.8%, almost just a hair shy of 40. And we'll be at 40 here shortly. 40% of homes free and clear. So when you look at that, just the numbers, if we looked at the median loan to value or equity in like 2007, 2008, it was like 6 or 7%. Now it's like 43, 44%. So just the amount of equity that people are sitting on, financed with 30-year fixed rates, there's virtually no adjustable rates in there in the mix. It's just such a night and day difference that anyone telling you a different story is basically lying to you. So economic data this week, Jeb, normally we are excited. This is the first week of the month. It's a big week. We get lots of jobs data, and it's been sort of drowned out and overwhelmed by all of the tariff news, which we're going to see was really, at least as of today and as of right now, much ado about nothing. We'll see how that shakes out. So JOLTS, the job opening labor turnover survey, this just tells you how many job openings there are out there. If there's too many job openings, that means employees have too much power to ask for wage increases. So you can see that continues to normalize, lower than last month, higher than 2 months ago, but still definitely normalizing back to what we saw pre-COVID. We got ADP jobs data today, Jeb. Last month, people were concerned this is a canary in the coal mine, but if you also go back, 8-10 months ago, we had a really, really low ADP. So it looks like every now and again, ADP just gets an aberration of a report, and then it kind of goes back to normal. So this is trending down, that there are less job creations every month, but not to like stall speed where you would be worried that we're headed to recession imminently. We have other data telling us that. This again, just showing hiring rate down, normalizing back to pre-COVID levels. Quit rate, people are not quitting their jobs. You're like, why does that matter? Why is that important? People that feel really good about their job prospects and their ability to go earn more money elsewhere, so wage-based inflation, they're likely to quit their jobs, and that is absolutely normalized. The layoff rate is ticking up, but still not to a level that is alarming. So tomorrow we get the weekly jobless claims. Friday we get the actual non-farm payrolls from the Bureau of Labor Statistics, and that will be an interesting one. Also interesting, Jeb, here, we've talked about how the further you get into the quarter, you get weird numbers, either hot or cold at the beginning of the month on this nowcast from the Atlanta Fed. I was expecting that we were going to continue to moderate. So if you see that blue bar in the middle and the blue line, that's the blue chip consensus. That's most experts that follow this, expert economists that follow this, what they're expecting us to end up at the end of the quarter. And they're not looking at what the data is today. So a lot of times you'll get the GDP now either higher or lower than where they're at. Well, they're starting to trend down, saying now below 2%. But that number by this point in the quarter should be converging on where that blue chip consensus is. Even if they don't end up dead on each other, they end up in the range. And we're getting further away from that. I didn't dig into it. You can usually tell what data, what report came out that fed into that. And I didn't have time to do it. But it bears watching. If we get another 3-4 weeks in and we're still seeing this down sub 2%, you're going to see those blue chip consensus numbers come down. I thought this was interesting for you folks at home. Jeb, this is the minute by minute chart of just today for Treasury bonds. So what happened today? Why all of this volatility? So we started this morning trying to break out of the bottom of that range, which is that yellow line. And then slowly just kind of went up all morning, and then kind of sideways. The chaos over there to the right side of that was the afternoon as Trump started speaking, shot up. We went from like 414 to 422 in a couple of minutes. He talked, and then about the time he was done, it just dropped like a stone, and we ended the day basically where we started it. Yeah. So you hear all the news, tariffs, it's going to be inflationary, it's bad for the economy. Any of those things could end up being true. Right now, the bond market looked at it, was worried about it, traded it, and then said, hey, you know what? We don't care. So interesting. Who knows what it'll tell us in the long run. This is the bigger picture. Jeb, we're below the 200-day moving average. This candle for today at one point was looking really, really bad. That movement at the end of the day tells us that not looking so bad, and we're still trying to break out of the bottom of that yellow sideways trend line, and we're within the blue or teal downtrend. So everything looks good from this perspective for bonds to continue working lower. I don't know that we have a lot of room to move lower, but we have some room. What does it mean for interest rates? Again, not much movement, a tiny bit lower than a week ago, flat day over day, even though we had a lot of volatility today. We had, when I woke up this morning, I always grab my phone and see what the bond market's doing. We see where rate sheets come out. Well, all morning we're getting reprices for the worse. And then after the Fed meeting or the announcement there from Trump, his press conference, then we saw him come back and we got positive reprices this afternoon. So a lot of volatility, but not a whole heck of a lot of action. Jeb, we didn't throw a slide in here because there's not really data to show a slide, but in terms of the rate watch, something interesting that you and I have coming up, maybe we should talk about, maybe you guys are interested, maybe you're not. We talked about Redfin getting bought by Rocket. Well, Rocket made another really big acquisition of one of the biggest mortgage servicers, Mr. Cooper, this week. So we see more and more activity aggregating among Rocket and United Wholesale Mortgage. And there may be a little war coming here soon that will benefit those of you who have mortgages and are looking to refinance. Not coming yet, but it would be a good time to get on that rate watch.
So my understanding, Josh, and not being in the mortgage business, I heard it from someone today, is that the expectation maybe is that if you have a Mr. Cooper loan, a loan that's currently being serviced by Mr. Cooper, you should probably join this rate list, this rate watch, jebsmith.net/rate watch, because United Wholesale Mortgage is going to offer incentives to their brokers to help refinance these people so that basically Rocket doesn't get that business. So what I would suggest is, I think it's probably coming down the line. If you're not already on the rate watch list, you should be. Let Josh, the team, watch rates for you. And if there is that incentive there, it could be the difference in making it worth it to refinance versus not. So I would check it out. Rate watch, jebsmith.net/rate watch will get you on that list. And again, you're on it until rates improve, and maybe they never do and you stay on it forever. But again, it's not a marketing gimmick. We're not sending your name out to anybody. You're not selling information, literally just there for to help you guys out. So with that, Josh, we've got Heather. Heather is in Inglewood. We got Dixieland in Minnesota. These are regular viewers that show up every single week. So thank you guys for being here. If you are watching at the moment, so let us know where you're watching from. It's always helpful to get an idea of where people are currently. And scrolling at the bottom of the screen, the webinar that we're doing on April 22nd, Tuesday at 5 p.m. If you're interested in understanding the home buying process in detail, Josh and I did this about a month ago, had a couple hundred people show up, actually helping a couple of those people right now buy a house, which is awesome.
3 of those attendees from January, so what, 6-8 weeks ago, are going to be homeowners here by the end of the month. So
that's awesome. And it all came from that. So if you're interested in becoming one or understanding the process or know somebody that is, make sure you register there. We'll keep in touch and update you as the time comes, but we're a couple weeks away. But just wanted to throw it on your radar so you know. Claudette is in Wisconsin. Miscellaneous said the whatever in Vegas. We got Manuel in Wisconsin as well. El Paso with ZL. We should just start writing these down so that we know, Josh. I mean, otherwise, like I'm like,
put little pins on a map.
Harbor City. We got Los Angeles, Sir Williams. All right. So what we're going to do now is we're going to start answering some questions. So hopefully you guys have started putting questions in there. I know we got a comment from Drew, another one of our regular viewers, just says, market looks better and better every day for buyers. It's about time. Let's get these millennials into homes. So yes, if you are a buyer, the market is softening. It is, and that is a positive thing. More inventory. Demand hasn't really picked up. So you got inventory coming, demand's basically staying the same, if you will. Maybe it's picked up a little bit, but that gives buyers more opportunities, right? We saw earlier 35% of the homes have some sort of price cut, which means depending on what you're looking at, could be a good opportunity.
Well, it's enjoyable writing pre-approval letters for people to go make offers, feeling like they have a chance to win without selling their soul, their firstborn, giving away every right they have in the United States of America just to get an offer accepted.
Here's what I will say, and I will, depending on where you are, we always talk about real estate being local. It is not easy everywhere, right? I've written 2 offers for the people that offer didn't get accepted yesterday. Both offers strong at asking price on both of those properties. Actually, one was above the asking price by 40,000 on that one, and they didn't get it. So it's not just easy out there. There's more inventory. It means it should be easier, but that doesn't necessarily mean that it is. So just
we have a viewer here. You know, he asked a question a couple weeks ago, and they're down writing an offer middle of last week down in San Diego, and it was a very nice house, kind of like what we talk about. It wasn't entry level, but it wasn't luxury high end either. But house was very nice, very nicely remodeled, and a lot of people are looking for nice inventory like that, and they ended up in a multiple offer situation.
Good stuff. Okay. So I changed the scroll on the bottom, jebsmith.net/start. If you want to get in touch with Josh and the team, start the pre-approval process. Want to get shop your rate, compare your rate rather. It's a good place to start. So Josh, we don't have a lot of questions. So we've been on for 15 minutes. We should just end now. We got 100.
We should. Like we have lots of comments, lots of people telling us where they're at, but maybe we have achieved our goal, Jeb, and we've educated all of the home buyers.
All home buyers.
They all know. They don't. There's nothing left to ask. They know it.
That is fantastic. That would be a dream goal, but I don't know that that's the case. So guys, instead of listening to Josh and I just ramble back and forth, which we can do, I'd rather answer your questions because, you know, again, that is the point of the show here. If you're just tuning in now, you're asking about the mortgage delinquencies rising. We talked about it at the beginning of the show. At the bottom line is you don't expect much lower home prices, right? I don't think that's going to be a trend in any way with delinquencies, right? We show you that the delinquencies are pretty minimal.
This isn't a hard thing to reverse engineer, Jeb. If you want to look and see where the weakness is going to be, look at the areas where inventory has increased the most rapidly.
Sure.
Within those areas, look where it had a high concentration of FHA buyers and a lot of activity in 2022, 2023, 2024. So you need a large proportion of higher risk, lower down borrowers that got in late in the game. And even at that, there's not enough of them to have a recipe for anything like 2008. But if you're looking in a market that has some of those hallmarks, you want to have a little more caution. You know, I listened to a viewer, had a conversation with a listener today, and we're going through it, and had just a really practical approach to it. It's like, I don't have to move. Don't have a wife. Don't have kids. I am happy in my apartment where I'm at with my finances and my savings. I would like to diversify some of my holdings to own a piece of real estate, but I don't have to. So he's out making offers, and he says, when I get the right deal at my price, I will do it. Until then, sure, I will stay posted up in my apartment.
And I think that's a good place to be, right? Not everyone can say that. And so, you know, it's good to be in a spot where you're not pressured. And that's really how you should approach it. That's why the earlier you do this, go through the process, the better prepared you'll be when the right opportunity comes. So don't just rush into it when you think you're going to buy. If you think, I mean, you know, when you're ready to buy, if you think you're 3-6 months out, start the process now so that you can work on things you need to work on and be in a position. So if you do see something, you're in that, in the right space to make an offer. So, and Tone, what do we got here? There we go. I can't read that, Josh.
He says, "Hey, Jeb, Josh."
No, name.
Oh, and Antion, Washington. Long-time listener, first-time commenter. Love what you guys do, spreading the facts, so thank you. Question: is it wise to refinance if you've renovated everything except your kitchen, backyard, and siding?
Josh, well, you could talk about refinancing. I mean, how much of that matters, right? So, you know, do you need to have your house fully remodeled to refinance? The easy answer is no, you do not. But I would look at where you bought that house, what the market's done since then, and what are comparable homes in your market selling for, right? Even whether or not they have the kitchen remodel done or not, what does that value look like? Do you think there's enough there for you to refinance and get a, you know, a value high enough that makes the refinance make sense. It's a good conversation to have with Josh, just to see where rates are versus where you are. First, to say, okay, the number makes sense if we get the value, and then there's a couple of programs Josh can use out there to get an idea of value and tell you whether or not it makes sense. So
this is what I love to tell people when we're going through this. In your favor, the reason why this is going to work out in your favor and you shouldn't wait, or it does make sense to refinance if there's a financial opportunity and incentive to do so, despite the fact of what condition your home may be in, is the best example I can give you. The people who have the perfect turnkey home, they just renovated it, is perfect. They come home and they smile at night because they have the greatest home ever. They are the most disappointed people in the world when they see their refinance appraisal. Now, if Jeb puts a sign in the yard, they may get dollar for dollar everything they put into that remodel. On the refinance, there's not another person on the other side. There's probably not another home in the neighborhood that perfect and that beautiful. So whatever is sold, they're going to go, okay, this one sold and it was nice. Yours is really nice. So we're going to give you $10,000, $15,000 more for it. And the people are just butthurt by this. They can't believe that no one understands that's a $450,000 remodel, but it just doesn't pay a whole heck of a lot. So to the flip side, what people get surprised by is my house really has a lot of deferred maintenance. We've had people that were essentially hoarders and put us off for like 2 weeks before we could send an appraiser out to do their inspection of the house. And the appraisal comes in just fine. They don't take off nearly as much as they should for homes that have a lot of deferred maintenance and need work. And they don't add nearly as much as they should when you have a beautiful turnkey home. So it sounds like, Antion, that you've done some work to the house. It's just not perfect where you want it, where you're planning to get it, but it's not going to hurt you in a negative way on a refinance.
All right, Josh, we might need Google Translate here. Bayardo is telling us hi to two amigos inmobiliarios. Do you know what inmobiliarios is?
I don't. If you were watching this,
I would think that we're immobile friends, but I don't know what immobiliarios means.
Boy,
I might not even be saying that right.
It's not even translating it for me in Google. It just starts bringing up Google results for that. I'm going to tell it to translate it to English for me. We're real estate friends. We're real estate friends.
Oh, so that's real estate.
Apparently.
Inmobiliarios?
Yeah.
Okay, we'll go with that. I like it. All right, I'm going to start using that. But thank you. Thank you for the comment. Let's see here. We saw budget with twins. So it says, I'm purchasing a house for sale by owner, no realtors involved. What should all be included on the sales agreement? Planning to sign tomorrow. Goes on to say, I should have added my lender gave me a letter that included main points. Just wanted to see if anything is missing. So I don't have advice for you here. Unfortunately, my advice is that you use a residential purchase agreement with a real estate agent that has the right language that protects you, the disclosures that protect you, because otherwise you're not protected. So there's a reason that our contracts, when you sign a contract, it's in the disclosures. I mean, this is 40, 50 pages in California. It's because of all of these things that have gone wrong over time. It's there to protect you. It's also there to protect the seller and the broker as well, but it's there to protect you as a buyer. So for sale by owners, you don't have that protection. And I'm not saying that just because I'm a real estate agent. I'm saying that because I truly don't know what you need in there. I mean, you need a lot of things in there. Too much to
have
just
you ever
talk
looked,
about.
Jeb, does LegalZoom offer that?
They might. I'm sure you can find a state contract somewhere online, but again, the seller has to be willing to sign that too. And the seller signing a contract like that puts them in a position where now they're obligated to a lot more things than just this,
We've been the lender in many FSBO transactions, and I can say less than 10% of the sellers are all of that savvy. They're generally just focused on no pay real estate commission and less about what is the risk to me in this contract and what I'm signing. You can do it. You can. I'm not saying you should. You can do it as simply as write the main details down on a piece of paper and send that to escrow, and they will put that in escrow instructions, and that can be the only agreement. But what works for a lender and what works for escrow is not necessarily what protects you as a seller and them as a seller and you as a buyer if any dispute erupts. What Jeb's talking about is just like on the loan side, when people get, I had some borrowers going in to sign loan docs. I always, before you sign loan docs, send out your estimated settlement statement, first payment letter, and the note. And I tell them everything else in there is basically legalese to cover the lender.
Sure.
I said, you're going to go sign about 70 or 80 pages of documents. These are the 5 to 7 pages that matter. And well, that's crazy. Why is that? Same thing with that 50 to 70 page real estate disclosure package. There's just a lot of requirements, state and federal, of what a seller is required to disclose to you. So it's really more of a risk from a seller, would you say, Jeb, than a buyer?
Yes and no, yes and no, right? I mean, I would say that as a seller, at least in the state of California, once you go into contract, the contract, in my opinion, favors the buyer a lot, because it's very hard for the seller to back out of that contract, right? It's very buyer friendly in the sense that, you know, if the buyer wants to back out, there's a lot of opportunities for the buyer to back out and keep their deposit. Whereas if the seller wants to back out, there's no way for the seller to back out unless you as the buyer are not performing. So in that regard, like if you have a contract signed, you want to protect your earnest money, right? So you need contingencies in place to be able to do inspections, to be able to do appraisals, to review disclosures. If you're getting them, you want disclosures. You want the seller to tell you what they know about the property so that they're obligated. If something isn't disclosed, there's something on the line there that says, hey, you said you were going to do this. So there's that. You need protection for title to be able to review the title report. If there's an HOA, all of these different things there to protect you, to keep your money. You also want to not allow the seller to not abide by the contract and get away with it if the legalese, if you will, in the contract is not stated there. So there's just so many little nuances that are there to protect you as a buyer that probably aren't going to be written into the contract. So you got to just, I don't know. I don't have advice for that, right? I mean, that's unfortunately part of the job, and part of why I advocate people have realtors is so that you don't have to worry about what if in this case. So sorry, I know I'm not a lot of help on that, but hopefully that gives you a little bit of insight and guidance as to how we're thinking about this whole thing. Josh Barry says, can a real estate agent do comps for a refi appraisal for loan docs? What's the accuracy compared to the one the company sends out? And the answer is yes. I mean, I can do comps. Josh can do comps to give you an idea of the value, but at the end of the day, it's the appraiser's choice, which comps they use. But what I will say is that, you know, if somebody calls me and says, hey, I'm thinking about refinancing my house, do you think the value's there? And I run the comps and I tell them, yes, the comps, then I'm pretty confident in what I'm telling them. And I could even provide them the comps and they might be able to show them to the appraiser, or, you know, speak to the appraiser and tell them. If I'm not sure, then I tell them that. So, you know, but the answer is yes, it can be, but it's not necessarily going to influence their decision.
Yeah, you're going to have to get an appraisal from a licensed appraiser unless you get a waiver of some sort, which we're seeing more and more of them. Not true waivers, but we're seeing Fannie and Freddie decreased the threshold for getting what's called value acceptance with a property data report. And instead of sending an appraiser out, they send someone out to take some pictures to make sure the house is in good condition, not like that it's amazing, just that the roof's not falling in, it didn't burn down, and take some measurements to make sure that the public records are accurate. So if you don't get that, you need a licensed appraisal going through an AIR compliant appraisal management company, that whole thing. But your realtor can absolutely help you. And what I like to tell people and help them understand is, if you want to know what your home is likely to sell for, you want an expert realtor that can go through the comps and tell you what it's likely to sell for. If you want to know what it's likely to appraise for in a refinance, it's likely to be different, because if you ask a realtor, the realtor's brain is hey, how much could I sell this house for?
Sure.
Versus what can an appraiser bring in terms of a value. Doesn't mean they're wrong. It just means that's how their brains work.
Sure. No, it is. This is exactly how I would think of it. Katie says, should a realtor have comps ready when they take me to a showing? What is the standard offer deadline before the offer expires? So there's two ways to view this. If I'm going out to show somebody a property, I don't have comps ready. And the reason for that is because I have no idea whether you have any interest in making an offer on that home. And so for me to spend time working on comps and going through stuff, for all the buyers I work with, that's a lot of time that kind of goes wasted. And it's not necessary, especially if you're interested in making an offer, if not interested in making an offer. So typically what happens for me, at least going to a showing, leaving the showing, asking, what you think. Hey, you're thinking about making an offer. Okay, now let me go look at the comps. Let me tell you whether or not I think it's priced correctly, where I think the value is, all of that. Now I can give a rough idea without running comps of whether or not it's priced right, but to actually look into the comps, I do it after the showing. Some realtors do it up front. I'm just not one of those. I've been doing it the way I've done it for a long time. If somebody asks me specifically, I'll do it. But other than that, not on every showing. Standard offer deadline before the offer expires. In California, the residential purchase agreement gives 3 days. That number can be changed. You can make it today at 5 o'clock, or I guess it's already 5 o'clock. Today at 8 o'clock. And you can make the deadline whatever you want. So you can adjust that number, but the contract's written for 3 days. Different states are different numbers. So just know where you're located, right? It might change. Coup. I got in trouble last time, Josh, on this one.
Don't
so
say
we're
it.
just going to go coup.
We're just going with coup.
Having a fully approved underwritten loan much better in an offer than a pre-approval.
Jeb, we've done episodes of the podcast before on red flags with lenders.
Mm-hmm.
We should go back and add this as an addendum. This is one of the top red flags in a lender, because we do a fully approved underwritten loan at pre-approval, maybe 1 out of 20 loans. And that says that we have some pretty serious doubts, or at least questions, about your qualifications. And we need to make sure that the way I've packaged and structured and am seeing your income, assets, credit is going to be seen the same way by the underwriter. If not, then there's not really any benefit or reason to do it up front. So what we find is a few lenders who shall remain nameless, who have awful rates, that what they tell you is, we're going to do these wonderful things for you. We're going to get you fully underwritten, because they don't have very many loans, because they have terrible rates.
It's nice of them.
So they're going to go through and get it fully underwritten before you ever go out, and tell you that you need this to have confidence that you're actually going to be able to be approved. And now you are locked in your brain. Well, I've already been through underwriting. I already didn't just do my application. I'm all the way through to underwriting. They probably also gave you a range of interest rates of what they might be, a really wide range of what interest rate you might get. Then you go get it under contract. And the other thing that they'll do, Jeb, I would bet, that they also told you, and we're going to give you a pre-approval, or you write a 10-day close.
And we're going to give you a free refinance.
We're going to give you a free refi if and when rates ever drop. We're going to close this thing in 10 days, and we're going to get you a fully underwritten approval. So, Jeb, do you maybe want to talk about how excited you and your sellers are when you get these offers with the pre-approval offering to close in 10 days?
I don't get them very often. But what I will say, here's what I'll say. As somebody that is a listing agent on properties all the time, and I see a lot of pre-approvals, do I care as the listing agent whether or not you've been fully underwritten? And the easy answer is no, I don't care. You're probably like, well, what does the seller care? The seller usually takes my guidance on this sort of thing. So as long as you've been pre-approved, I can have a conversation with your real estate professional or your mortgage professional rather, and they can walk me through your pre-approval. If it's not just pretty easy to understand, that's all I need. I don't need guide. I don't need you to be fully underwritten, whatever, because at the end of the day, it doesn't really matter unless you're saying that you're trying to close in 8 to 10 days, which in most cases sellers can't do anyway. I mean, sellers don't want to do that quickly. So in most cases, it does not matter. Just get pre-approved and you'll be good to go. So easy answer. We got Undone says, thanks. Dude, my eyes are definitely getting worse. Like I swear, like I'm over here blinded.
You don't go blind. You got it? You sure?
Yeah. Thanks for your time. Looking to move from California to Texas, Dallas, Fort Worth area, hoping to buy a new construction. Would I start by shopping around lenders first and then seeing what buyer's lender offers? Josh?
A couple things. Never a bad way. I mean, it's not like it's going to cause you problems, but you're going to have to pre-approve with the builder's lender. So if you go out there and you see a builder and it's a development that you like, start with them. Start there. And if they're offering you $10, $15, $20,000 in costs, if they're offering you, you look at Mortgage News Daily and it says rates are 6.7 and they're offering you 5.99 or an FHA at 4.99, you know that they are offering monster incentives and there's no outside lender that's going to touch that. Like I go back, like there's sort of this obsession with shopping. The shopping should not be about an interest rate. It should be about someone you connect with, that you feel has competitive terms, and that you feel knows what the hell they're talking about. Because the people that we get calls, Jeb hears them every week, multiple times a week, someone crying, things are going sideways, they're not happy with what they're doing. And how did you find it? Well, I made 22 calls and I found the cheapest guy in the world. And then now he's not delivering, doesn't answer my calls and doesn't do anything. So price is an important component, but when you're shopping, don't focus on that. And in this instance, there's likely not to be shopping because Texas builders are wanting to move homes. They're offering monstrous incentives. So calling outside lenders, calling someone like me, I'm going to ask, cool, did you go talk to the builder's lender? What are they offering? Occasionally, you know, in a year, we'll do 2 or 3 pieces of new construction. Either it's a builder in an in-demand area that doesn't have to do incentives, so they're not doing anything special for you, or it's someone just got fed up with the BS of dealing with the builder's lender. So short answer is just go to the builder's lender and get that pre-approval. Then once you find a property and have it under contract, get their offer, call another lender or 2 and see if it's anything that can be touched.
All right. ZL was in El Paso, but says when looking at buying, I'm looking at things that can't be changed, like square footage and neighborhood. Would cheap doorknobs, weird paint colors really tank a home's value to savvy buyers? No. No, but home values
how many buyers are savvy is the tricky question, Jeb, because I've been in many houses that they're sitting there and you're like, this is a nice house. It just needs some paint and some flooring, a few different things.
Yes, correct. Not an inaccurate statement. But what I will say is, like, what drives the value of a home? I think that's probably the easiest thing to look at, right? Bedrooms, bathrooms, square footage, location, probably more so than anything else. Lot size, upgrades that the home's done. Paint doesn't really matter. Flooring, it doesn't matter. To the buyer, yes. To the value of the home, probably not. You know, in most cases, right? Unless it's just completely trashed or whatever, then it might affect the condition on the appraisal. But for the most part, it's going to have very little impact on that sort of thing. So I think you're looking at the right things. But what I will say is, with that being said, when you're looking at the right things, look at the homes that aren't getting the attention because they have these things in them. That's where the value is, right? The people that can't see past that, like Josh said, that's your seller. That's where you want to make an offer, especially if you have the eye to be able to make these changes. You know, that's where that's how you get that increased equity immediately upon buying is being able to buy those and make those changes. We got a response back from the twins, Josh. 15-day contingency periods detailed out, getting an inspection. So good stuff. And they said we were helpful. So we'll take that. Because
I like being helpful. It's better than the alternative. Just ask my wife.
Exactly. Never helpful, she says. She's probably going to text me here in a second once we said that. She actually watches the show, guys. Can you believe that? My wife doesn't watch the show.
My wife enjoys it. She says it's a highlight of the week. She likes it.
Highlight of the week.
She likes listening to these two chuckleheads.
Yeah. She could do that off air. We don't even need to be on here. Joyce has a good question. Says, is it normal for new servicers, explain what a servicer is, Josh, I think here in a moment, to charge excessive fees for the renewal of annual homeowners insurance policies, such as an increase of $600, $50 a month? We got transferred to Carrington Mortgage. So what does that mean?
So the servicer is who you make your monthly payments to. We talked earlier, Mr. Cooper, one of the big ones, Lakeview Loan Servicing, Carrington is a big one, Freedom Home Loans. They acquire servicing rights and you will make your payment to them. They may actually own the loan. They may just be servicing for someone else, which is collecting your payments. So the most important thing here to know, they cannot charge you anything. There is no charge for servicing your loan. They get paid by the owner of the loan, either themselves or whoever owns that loan, a percentage of the monthly payment for doing the servicing. They cannot charge you anything. So this change of $600, it's either coming from your homeowner's insurance, that was the increase in the insurance over the year, or you let it expire. They could put forced place insurance in, which most times the homeowner doesn't let it expire. The homeowner didn't provide the updated information that the servicer was asking for, which can be frustrating. I literally had this. So one of my home loans is with Chase, and Chase sends a thing the other week. I'm like, what are you talking about, you idiots? I just literally right here, you just paid the renewal on it, and they're telling me I need to give them new information. But from that perspective, nothing can change. So if you have an increase in your monthly payment and the premium for the homeowner's insurance hasn't changed, the property taxes hasn't changed, it's because every 12 months, at least once every 12 months, they have to go through and do an audit on your impound account, and they can only have so much in there. So if at any time in the next 12 months, they're going to have too big of a cushion in there, they have to refund some money. If they don't have enough, then they can say, hey, we're short of where we're allowed to be by law, and they can increase your monthly payment. So just super important to know, they can't charge you anything. They can't change anything. So it was either a change to your homeowner's insurance or your property taxes went up, or they went up and they were under collecting for a period of time. So they've increased the payment to make up for it.
Good stuff. Good question here, Mike. If you're seeing this on the screen, let us know what your balance is on your first mortgage. That's going to be helpful in order to answer that question. So we need the balance on the first to be able to tell you whether or not that makes sense.
And also clarify the question. Is it good to blend your interest rate?
I think it's about refinance, blend them together.
Combine the two of them?
That's what I'm thinking he means. Okay. So just we need to know the balance on the first.
He says 245.
Okay. So Josh, he owes 245 at a 4% interest rate. $68,000 at a 12% interest rate. Does it make sense to blend those together and get a 6.5% interest rate today?
Probably not right now. Let's say what 68 is about 25% of that 245, a little bit more than that. So it's about 20% of the total balance. So really, you're probably looking at a blended rate of about 5%, and the market rate is going to be 6.5 or more, no matter how you structure your loan. If you want to pay points, not pay points, whatever what your credit score is. So probably does not make any sense right now. That HELOC at 12% should not be that high. So if you have good credit and you have some equity in your home, you can probably just redo that and get it down somewhere in the 8.5 to 9.5 range. Not going to make a huge difference, but if you could do it with your local bank or credit union, they don't charge you anything. 3% on 70,000 is $2,100 a year. It'd be worth doing.
There you go. Hopefully that was helpful, Mike. Good information there, Josh. Way to come off the cusp with that. Steve,
we try.
Any concerns with the OC multifamily markets? What pitfalls should you look for when buying your first multifamily home? No, I have no concerns other than the fact that buying a multifamily in Orange County without a substantial down payment makes this much sense right here. You see this?
If you're not doing a 1031 exchange and rolling a couple $1 million from one property to a better property, don't do it.
It requires too much money for a down payment. And what you're going to get out in the rents are never going to cash flow without probably 30-40% down at least on some of these properties. So no, I have no concerns other than they're just expensive, and it doesn't make sense to put your money into them. I don't think there's defaults or anything like that happening that if that's what you're asking about. Most of these properties were bought a long time ago, have a lot of equity, rents are good, and nobody's going to sell them unless they're, find a better asset out there that's going to return, a better, ROI. And quite frankly, there's not a lot of it at the moment. So hopefully helpful.
Jeb, my math skills on the fly were not good. Not good. Going back to Mike's blended situation, I threw it in a blended rate calculator. I thought it was about 5. It's 5.75.
Okay.
So you're not that far off. Like we got near that level last fall. So if you wanted to combine it at that point, it could make sense. It's not a huge savings from that standpoint, but it would at least fix it, and you wouldn't have to say any part of it is at 12% at that point. But yeah, 5.7 on the blended.
So if you do have a interest rate looking to refinance, jebsmith.net/rate watch there on the screen, QR code, you can scan it, fill out that information. You're on a list. And if rates go down, can reach out and help you take care of that. So Josh Brett has a question, says, do buyers still include a letter to the seller in their offer? Have you noticed people in the offers, people win offers that way? Are you allowed to do it? I'm in Pennsylvania. So are you allowed to do it? The answer is depends. In the state of California, there's basically a box that gets checked on listing agreements, whether or not the seller wants to see them. There's this overarching belief from the National Association of Realtors and different trade groups that they influence how sellers pick offers. And the reality is that that's true. And that nobody should pick an offer based on something that's written in a letter. It should be based off the merit of the offer, so on and so forth. But a seller can ask to see them. And if you write them and the seller says yes, then you submit them. What I will say is most sellers want to see them in most cases, but some brokerages, some agents out there don't want them, don't want to show them, don't want to send them in. So kind of all depends. I would just talk to your real estate agent, have them reach out to the agent on the other end and say, hey, listen, my client's interested in the property. You know, they would like to write a letter to the seller. With that said, you can't really talk about, you know, you're not supposed to include a picture, right? Because at that point, they know your race. They know things that may or may not influence an offer. Shouldn't, but may or may not. And all you can talk about is basically the property and what have you. You're not really supposed to talk about, you know, yourself and whatever. But I don't know. I'm more open than that. I'm not. I think
Jeb solicits headshots with all offers. So
listen,
if you could
you know, if my seller's okay with it, you want to write a letter, by all means, submit it. That's how I feel. I mean, at the end of the day, people want, you know, think of people that were raised in their homes. They grew up in their homes. They want certain things. And I don't think there's anything wrong with wanting something for your property you're selling. Maybe I'm wrong. Maybe I'm old school. It is what it is, but that's how
I'll look at it this way. Do we all know some cranky old, probably white man who sits there and he wants his neighborhood to be all white like it was 50 years ago,
Sure.
and he only wants a certain type of person? Yeah. Those people do exist, but they're few and far between. And I don't think not getting letters or pictures with the offer are going to prevent them from going through and reading surnames or first names and making judgments about who, like, that person's going to do what that person's going to do.
Right. I'm pretty sure I could find Brett Landis on the internet if I wanted to find Brett. Right. I mean, it's not hard to do. So if
I'm
that's your
looking
motive,
at Brett Landis's little picture here. Are they at the fair or are they in Mexico? I'm more excited if they're in Mexico, but it looks like,
you know, I can barely read the stuff that's on my screen, much less see the photo, Josh. But I think they used to be the Landis family or something on here. I think there's a name change. I think there was something going on where there was a family in the
they got rid of the kids.
I mean, maybe they decided they don't want kids anymore.
And they went to Mexico and retired on the beach.
Maybe he's solo.
Kids didn't
maybe
fit
he's
into that.
maybe he couldn't get a house with the wife and said, you know what, I'm out. I'm going to get my own house.
I like it.
Miscellaneous of the whatever for refinancing. Does it make a difference whether or not I have mortgage with Freddie Mac versus Fannie Mae? Josh, does that make any difference?
No. Fannie Freddie guidelines are virtually identical. Some very, very minor changes, differences between the two, but none when it comes to refinancing. And if you go back, they both require appraisals. They don't have a streamline like FHA and VA do. And when we had issues in the past where they made exceptions or put a new program, the Home Affordable Refinance Program, it applied to both of them. So no, don't really have any issues there.
Excuse me. James says, I have until the 16th of each month to make my pay my mortgage rather, and been paying the second 12th.
The 2nd through the 12th, somewhere between the 2nd and the 12th.
You. Okay, got you. Does this count against me paying closer to the 16th, Josh?
I have a question for you before this.
Yes.
So do you use auto pay or do you go in and
I use auto pay.
What day does your auto payment go?
First.
Yours goes on the 1st. So this will tell you, Jeb and I are a little different. Mine goes on the 15th. So that James should tell you that there is no issue. So as long as it
the
gets
16th
there,
does matter though.
The 16th
then it
will
can be
matter.
late.
The 16th will matter because if it's not received until the 16th, they'll hit you with a late payment penalty, which is up to 5% of the payment. If you have a $3,000 or $4,000 house payment, it's real money. But for me, it's one of those silly things. Like there's plenty of bills that come due the 1st of the month. So this is really the only one I put kind of towards the middle of the month. I have it go on the 15th.
I just wanted to get out and I don't want to see it again.
And I say that I've got 2 others that go like on the 4th or the 5th. I don't have any of them go on the 1st. I don't like to feel bad about the first day of the month.
The first day of the month hits hard over here. The 1st and the 10th are not good days when in my bank account. So, but anyway, so you typically have until the 15th to make your payment with no late penalty, right? After the 15th, typically there's a late penalty involved, and that goes from the 16th until the 30th, or till the 30th. After the 30th, it really matters if you haven't made your payment, because not only are you getting a late payment, you're getting a hit on your credit report, right? So you got 30 days to make that payment with no hit to your credit report, but you got until the 15th with no late payment. So I would try to pay it before you get that fee. If you can't do that, then it is what it is. You're going to pay a little bit more.
Jeb, for the webinar that we're going to be doing for first-time buyers, one of the bonuses we're putting together, I'm putting together a guide on maximizing your credit and your credit score for the purpose of getting into a home as cheaply and affordably as possible. Probably the thing that I walked away with, like, I don't know why I don't tell people this more. Like, put every recurring bill that shows up on your credit report on auto pay. You can put your credit card on auto pay to just make the minimum payment on the last possible day before it's late every month. But you guys would probably not be shocked to find how many times I have people who had perfect credit and just spaced it, forgot to send a credit card payment in 1 month. And it's a 40, 50, 80 point hit to their scores. So from that standpoint, get everything on auto pay so that if you mess it up and you forget to make that payment, that there's a backstop there. So you don't ever have to worry about that. Because I can tell you, I did this. I spaced it on a payment, Jeb, in like 2013. And it didn't fall off till 2020. And after like 2 years, had my credit score healed? Yeah, but it was like a 795 credit score. As soon as that thing fell off at the end of year 7, it was immediately like 30, 35 more points, where it was an 830 credit score after that fell off. So was it making a difference to me? No, but like just psychologically, you like to think I have perfect credit. If someone pulls my credit, it's all zeros in terms of the payment history. But for what it's worth, those are my thoughts.
All right. Antione, Jeb, do you see any ROI with an EV charger added to your home, or is it a non-factor like solar panels? EV chargers, no, it's a nice to have if you're a buyer, right? If you're a buyer, you electric car, it's a nice to have. Are you going to see an increase in value because of just an EV charger? No. Solar panels, I wouldn't say is a non-factor. For some people, it's a non-factor, but paid solar panels on a house can increase the value of the home. That's
how
entirely.
Often do you see paid solar panels? They're all
not always.
That buyer down in San Diego that we were talking about earlier, it was like this $200 something a month lease that they were taking on. Another buyer here from the show, they backed out on a property because he said they got screwed so bad on their solar lease that for the same installation that he had financed like $35,000, they had financed $80,000, and they wanted him to take on that lease. And he's like, no way. No way. So it can be a very bad thing. If you're not good at shopping for things, don't go get solar because it's the cool thing, because you can put something bad on there that buyers are going to discount your property for.
There you go. It's almost, we've been over here just over.
Did you answer the part about EV chargers when I went on the rant about bad solar?
Okay. I had already talked about it. So hopefully that was helpful for you. Sir Williams, streamline refinance, able to take his rate down about 0.5%. Save about $250 a month, $3,100 annually, no cost. Is it a good idea, Josh?
Couple things here. That is a big savings, only going down 0.5%. To be streamline eligible, you have to drop at least 0.5%. So that's the minimum savings that you can have here. I'm also wondering why that rate is so high. With a good credit score, a 640 credit score, even, at least 0.25% lower than that on a no cost with a good 640 plus credit score. So I don't know where you're at, but if you want us to review it, I'm happy to look at it. And if someone's doing a good deal for you, we're not trying to steal people's loans. If they've put something good together for you, we'll give you, just the thumbs up that, hey, you're in good hands. So either way, regardless of where you're at, use Jeb's link there.
Scroll in there at the bottom. Yep.
Yeah, use the link and get in touch with us. More than happy to look at the loan estimate and see if it looks right or if there might be a better option for you.
Good stuff. So with that, guys, if you found any value in tonight's episode, make sure you hit that thumbs up. Subscribe to the channel if you've not done so already. Trying to hit 6,000 subscribers on The Educated Home Buyer, 120,000 on my channel. Appreciate you guys. Appreciate all the support. Thanks for being here, continuing to support the show. As I mentioned earlier, Educated Home Buyer Seminar is going to happen on April 22nd. It's scrolling the bottom right now. Free for anybody that wants to join. It's about an hour and a half, walk you through the entire home buying process. We're helping 3 people right now that went through that process. They're going to be homeowners. 5 p.m., April 22nd. jebsmith.net/webinar. Sign up. But until next week, guys, buy right, borrow smart, build wealth. Adios.
Amigos inmobiliarios.